Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is securities and private placement expert Mauricio Rauld. Now, Mauricio is the founder and CEO of Premier Law Group, a premier boutique securities law firm. As a nationally recognized expert on private placements, Mauricio specializes in Reg D exempt offerings and educates investors from around the world on how to navigate the complex world of securities laws. And so, guys, I'm excited to get onto the show with Mauricio. But before we do, I just have a few quick housekeeping items to run through. First and foremost, I've mentioned in the last couple of shows, but I just want to remind you on how to get a free copy of my recently released best-selling book called The Cash Flow Investor: How to Create Financial Freedom Investing in Commercial Real Estate. I just released the book in print form, and it's for sale on Amazon for $20, but I'm actually I've made a free PDF version available for a limited time to my loyal cash flow tribe here at the Real Estate Investing for Cash Flow podcast. So go over to kevinbupp.com/free book. Again, kevinbupp.com/free book to grab that free copy. Moving on here, seen a lot of changes over the last month or two. A lot of you guys always reach out and say, hey, what are you guys up to? New offerings, new deals, this, that, and the other. And, I'd say that the beginning of this year was fairly slow for us. Had a number of deals under, that we were looking at in LOI or in under contract, but ultimately, it's been slow. We've done a few deals, but not nearly as many as what we had historically. But I would say that deal flow just over the last 2 months has really kicked up quite a bit. And I just got back literally yesterday or last night from a due diligence trip to Washington, D.C., where we have a Class A parking garage under contract in one of the premier neighborhoods in DC and within walking distance of the White House. And, like many of our deals that you guys know, I'm all about direct to owner, off market deals. And again, like many of our deals, this one also was sourced off market direct to the owner, which is somewhat of an anomaly. Very rarely do you get direct to owner Class A type deals in markets such as Washington, D.C. But ultimately, we've been pounding the pavement for many, many months and years now. And so we've got quite a good bit of deal flow from off market deals just like this one. In addition to this opportunity, we also have another, roughly $60 million or so of both parking assets as well as mobile home parks under contract. And so, guys, if you're an accredited investor, you want to learn more about the current offerings that we have available, you can go over to investwithsunrise.com. Again, investwithsunrise.com, get access to our offering docs and what have you, and see the different funds that we have available. Again, in addition to these mobile home park and parking deals, we also recently launched a brand new build to rent opportunity in Phoenix. Again, if you want to learn more about this or the mobile home park or parking opportunities that we have, go over to investwithsunrise.com. And so, guys, with that, I'd like to welcome our guest for today's show, Mauricio Rauld. Mauricio, how you doing, my friend?
Good, Kevin. Good to see you, man. And looking forward to this.
Yeah, excited to have you here as well. And as we were talking about before we started the show, I couldn't remember. I just looked back. I have not had you on the show, which is crazy. I know I saw you roughly, I think it's been a year ago at Rod Cleef's event down in Sarasota. I think that was kind of right when people were starting to go back to live events. In fact, that was the first event that I was at live, over the period of COVID. And so I'm glad to say that I think we're kind of back to normal, maybe not 100%, but we're fairly back to normal now, especially with like live events and conferences and things like that. And so just excited to have you here more than anything else. And I know there's been a lot of things going on over the last, more than just COVID, more related to, securities laws. And there's a lot of changes that have happened over the last couple of years and things that are coming down the pike here. And so I'm excited to cover all those different bases with you today, Mauricio. But, before we do, you're a famous guy out there in this world. You've been all over the place. Your face is all over YouTube. You're a celebrity, buddy. You're a celebrity. But for those that might not know you, might not know your name, what I'd love for you to do, if you could, take a few minutes. I'm gonna pass the mic back to you, and then fill in any of the blanks about your background. I gave you that very high level bio, but there's a lot more to it. And so tell our listeners a bit more about yourself.
Well, thanks, Kevin. And I wouldn't consider myself a celebrity by any means, but I'm the founder and I'm the founder. I founded Premier Law Group. But, I've been a syndication attorney now. That's 100% of our practice and what I do for about, I've been doing this for 22, 23 years, but on the syndication side, really maybe the last 8 or 9 years now that I've been doing it. I had the typical path when I, went to law school, and, my dream was to land a great, corporate gig at a large law firm and, living the life and all that stuff. And I did that for a little bit. And then fortunately for me, came across a little purple book by the name of Rich Dad Poor Dad, which I'm sure you're aware of and read, and I'm sure all of your listeners have. And that really changed my whole mindset and, everything, and just realized that what I was doing and working the 9 to 5 and getting up, as lawyers, we get up super early and we work crazy hours and work weekends and we bill by the minute. And it just wasn't the lifestyle that I wanted. And I would see law partners doing stuff that I'm like, I don't want to be doing that in 20 years. And so, back in, I guess it was now almost 20 years now, I was fortunate enough to read the book, and that led me to the Real Estate Guys, which I know you're familiar with too. And I was actually their general counsel for a while. That was kind of my transition from the corporate world. And then in about 2006, 2007, I just started my own firm, Premier Law Group. And, at the beginning, you kind of do whatever puts food on the table. But as time has gone on, I've really focused my practice to do just syndications, real estate syndications. And like I said, for the past probably 8 years now, 9 years, that's all we've been doing. And so that's our bread and butter. I do consider myself and our team, probably the foremost experts in the field, because that's all we do. We don't do anything else. We don't do contract work. We don't do, estate planning. We don't do any of the other stuff. We basically focus 100% on the syndication. So nice thing about that is we've learned all the rules, we know what's out there, and we can be a little bit more creative when we're talking to clients and somebody wants to structure something or has a problem. We don't have to worry about going to the library and looking up the law. We know it. It's in the bag of tricks that we have in the back that we can dig into. And so we can focus more on the creative. And I think I have built a reputation of being maybe one of the more creative attorneys out there. I love the saying is, if you want better answers, or if you want world-class answers, you better ask world-class questions.
Yep.
And so I like to ask, how do we do this? How do we do that? Not, hey, you can't do this, you can't do that. I always try and find the way to do it, because that kind of opens your mind to be creative.
Yeah, no, I agree with you, and appreciate you sharing that background. And for today's show, I'd like to stay away from kind of the basics. I'm going to make the assumption that most of our listeners, they know what securities, the high level understanding of the securities law, at least of how that is applicable to real estate offerings and raising capital for deals and such. And so we're not going to cover the basics today as it relates to syndications or Reg D offerings. But what I'd love to do, Mauricio, is you'll talk to any changes. What's going on in the securities world? Are there any recent changes that have taken place? Any changes that are coming down the pike that you feel are relevant for our listeners to know about?
There's been a ton of changes, actually, and I'm going to step back a little bit to sort of the change that I felt right around COVID. So it's been, it's obviously been a couple years ago, and it's not necessarily a legal change, but it is something that's going on in the syndication world. And that is the shift that we've seen since COVID of people wanting to do more and more funds, sort of blind funds, or go raise large amounts of capital for, a particular asset class or maybe multiple asset class versus doing project specific deals. That's just been a shift that it's so clear. And I don't know if it's just happened to be around the COVID time and it had really nothing to do with that. And it's more that there's so much money in the system that people want to just go grab it and without having a deal. But that's something that our practice has really just blown up in terms of the amount of funds that we do and fund of funds. People are now trying to do funds to go and invest in other deals. So I'm getting a lot of questions, and we're putting out a lot of content on the legal ramifications and legal considerations of doing a fund, or specifically a fund of funds, versus doing a project specific syndication, because it does open up a whole new world of compliance and legal statutes that we usually don't think about. But because people are shifting towards that, we're paying a lot more attention. And most syndicators don't realize all of the additional can of worms that get opened when you decide to go do not necessarily just a regular fund, but specifically a fund of funds. Now that changes a lot, and so we've been doing a lot of content relating to that change.
Okay, maybe speak to some of those changes, and maybe we'll back up a step and maybe speak to what a fund of funds arrangement is. I feel like that concept, although not new, I think it's we can agree that it's fairly new to the retail world, right? And in fact, there's even a little bit of a different definition if you go to the institutional world of what a fund-to-fund model is to what us retail investors, or on the retail side of things, consider to be a fund-to-fund. But just generally speaking, maybe give our listeners an understanding or definition of what a fund-to-fund is, and then what role it plays in a capital raise or in a fundraise.
Yeah, let me explain what it is, and then I'll give a specific example, and then I'll tell you why I think it's actually becoming more and more prevalent. So the easiest example is, say, Kevin, you found a piece of property under Sunrise Capital, and you're raising, I'm going to make something up, you're raising $10 million to go buy a particular asset. And then Mauricio comes along and says, hey, that's a great asset class. Let me go raise my own fund. Mauricio goes to raise my own fund for the specific purpose of turning around and then giving Kevin maybe $1 million or $2 million or $5 million, some portion of his raise, and do that. And so that's what a fund of fund is. I used to call it sort of, a sub syndication is something that I used to call it, but I think most people, the vernacular now is fund of funds. But it's simply, it's generally people who don't really want to operate or maybe aren't very good operators. And so they're like, well, I can go raise money, but I don't know anything about mobile home parks, or I don't really know much about, parking lots and what have you. And so let me raise the money, which I'm good at. And then let me turn around and write a check to Kevin, because I know Kevin's going to take care of my money. That's what it is. And the reason that has been popping up is simply because one of the things that we have in our legal system on the syndication, there's a big void, right? And what happens is, you cannot raise capital for other people, right? Unless you're a broker dealer, you've got to be licensed, just like I can't practice law without a license, a doctor can't practice medicine. You can't really go raise money for other people unless you have a broker dealer license. And unfortunately, there's a gap because broker dealers, unfortunately, they don't get out of bed for 50 or 100 million bucks. So even if you wanted to go use a broker dealer and pay somebody 6% or 8% commission to go raise a bunch of money, like the JP Morgans, like the Merrill Lynch's do, they don't want to do it. I mean, there are a few, and we do have clients that do have some smaller brokers that do it, but it's very, very difficult. Mm-hmm. And so there's this gap where the law says, well, you got to go get a license, or you got to use a licensed person. But then in reality, when we're out there raising $1 million, $5 million, $10 million, $15 million, nobody wants to do it. And so that gap, that void has basically been filled by this mechanism of doing a fund of funds, where somebody can, if done properly, which is a big if, because most people don't do it properly, but if it's structured properly, it allows somebody, like, say, let's again use Mauricio as an example. Like, I don't know anything about mobile home parks or whatever, but I know how to go raise capital because I'm a good marketer. I've got really good, relationships. I can easily go raise $10 million. And so I can go raise $10 million, give it to Kevin, give it to John, give it to Peter. And then I can actually get compensated for doing that because I am actually creating value for my investors. And that's really, I think, the big hole of what people are doing today, is that they're not really providing too much value. They're literally raising money and giving a check to Kevin, right? They're just a conduit. But if you do it properly and you actually do provide value, then it's a legitimate way for me to really be a capital raiser without having to, be a broker dealer.
And my guess is that there's probably some type of, beneficial economic terms that the lead sponsor of the primary syndication gives that fund of funds sponsor in order to, give them incentive to go form their own fund and actually raise capital from their network. Is that correct?
100%. And that's actually one of the values that the fund of fund manager, again, let's just use the example of me and you, the value that I bring to my investors is I do go down to Kevin and say, Kevin, I'm going to write you a $5 million check because I've got this fund of funds and I've got money to allocate. But hey, I don't want to get paid the same you're paying your common investors. I want a better return. I want, it's going to be, I'm bringing you half of the raise or a third of the raise. I want some preferential treatment. And that preferential treatment is obviously passed along, or some of that preferential treatment is passed along to the investors. Not to mention just the opportunity itself. I mean, most of my investors, for example, don't know Kevin, don't know the amazing, deals that you have. And so just being aware of the opportunities, that's a value that I'm bringing to my investors that they otherwise wouldn't have felt. But you absolutely negotiate better terms, which again makes it a little bit difficult for the actual main syndicator because they have to think of that beforehand, right? You can't, as you know, you can't put together a deal and have your PPM and have all your legal docs in place. And then Mauricio shows up and says, great, I'm going to give you half of your raise, but I want kind of like private equity terms, and I want to be first in, first out. I want to have preferred returns. I want to do all these things over the current investors. Mm-hmm. You obviously can't do that without having to go back and redo all the docs and disclose everything to your investors. So it just has to all be planned out ahead of time, but it is possible. And in fact, we have several clients that do it, and it's a very effective way as long as it's structured properly and you're actually truly adding value, meaning Mauricio would be truly adding value to my investors, which, by the way, Kevin, let's talk about those. I'm going to do the due diligence, right? I'm going to go fly down to sunny Florida, and I'm going to meet you. I'm going to meet your team. I'm going to do my due diligence on you. My investors are busy professionals. They don't have time to go get on planes and go fly to Tampa. So that's something I'm bringing to the table, which is I've already done due diligence on the team, on Kevin and everybody. Then there's a deal. Well, crap, now I got to go fly to wherever the deal is, and I'm going to do my due diligence on the deal. And so all those things are things that are going to be valuable to my passive investor who's just is too busy for all this stuff. Not to mention that I'm going to negotiate better terms. Maybe my pref is higher, maybe, whatever, additional revenue I'm able to bring in because, we have the power of the group. I'm coming in with 5 million when most of your investors are coming in with 100 grand. So there's a lot of benefits that I can negotiate on behalf of my investors who are busy professionals and they just want to write a check and don't have time to do all the things that need to be done.
You made a comment earlier on that there's, you see a lot of folks that do it incorrectly, right? Like, so like it definitely is it's an above board way for those that maybe aren't good operators themselves to, that have a network of high net worth individuals that they feel they can raise money from for the right opportunity. So it's a good opportunity for those individuals to put together their own fund where they don't necessarily have to be the best at the asset management or the operations side of the business. But what are some of the big mistakes that you see these fund to funds make as far as structuring or just, what are the general, I guess, legal mistakes that you see across sports? I'm sure you see a lot of it given social media and everyone's presence out there and promoting deals that they have, what have you. So what are some of the big ones?
I think the main mistake people make is that, and we actually don't do these. And so you can probably figure a way how to do it, but we just don't do it. We think it's just too risky. And that is somebody who just basically raises money for one person. So again, Mauricio, I meet with you, Kevin, and you're like, hey, I got a $10 million deal that I have. And I'm like, I can go raise money for you, Kevin. I can go to the marketplace. I can get $1 million. I will then show my investors your specific deal with your numbers and what have you. But the whole purpose of my fund is to raise $1 million to then turn around and give it to you. Right. That's just a structural, I don't want to say smoke and mirrors, but at the end of the day, I'm just raising money for you and the money's going to, whatever additional money is coming through entities but ultimately you're going to end up in my pocket. It's just another, it's a way around the broker deal laws. And theoretically, there might be a way that you can just add so much value to your investors somehow with that one particular deal that you might be able to pull it off. But we don't do those. What we recommend is for people to do a blind fund. So when Mauricio does his funded funds, he's not talking about Kevin's deal or John's deal or Peter's deal. I'm just raising, we call it a blind fund because I'm raising $10 million to go buy, maybe I list a specific asset class, but I'm basically my job is to go find the deals, find the relationships. That's really the work that I'm doing. And so a blind fund is the way to really do it properly, where I'm not even mentioning Kevin's deal, because that's part of what I'm doing. I'm almost like stock picking. I'm going out there and I'm saying, well, I got 6 syndications out there. Let me go do my due diligence on these 6 or 10 options. And then I'm going to make a decision and negotiate with Kevin on that deal. So that's probably the first thing, sort of just from a structural standpoint. And then I think the main other mistake is just not understanding that the whole new can of worms over here opens up when you're doing a fund of funds. And there's a lot of them, but let me just talk about probably the main one. And that is, unlike, for example, Kevin, let's say you're buying a mobile home park asset, you're investing in real estate. Yes, there's an LLC in there, but basically you're just holding that as title. You're in the business of raising capital and buying real estate, right? You don't need a license. You don't need to have a special license to go buy real estate. Anybody can go buy real estate. But when you do a fund of funds, if you think about it, what you're actually doing is you're raising money to go buy a stock. I'm buying stock in Kevin's company. It's really LLC units, but I'm basically buying a security at that point. I'm not buying real estate. I'm buying a security. And that makes me, as the fund manager, an investment advisor. And so that now opens up the whole world of investment advisory rules, which most of the time is a state-by-state issue. Because unless you've got $100 million in assets under management, which most fund of fund managers do not have, then we're going to go to the state where you actually live. So I'm in California, right? So I would have to go to the California state regulator and find out, do I need to register in California as a registered investment advisor, or is there some exemption in the state of California that allows me to do it without? And it's not 100%, but I think there's 3 or 4 states that don't have exemptions, but the vast majority, almost all of them, have exemptions. So you don't have to register, but you have to follow all their limitations and all the regulatory framework that they have. And some states, like Pennsylvania always comes to mind. I got surprisingly a lot of clients are in Pennsylvania. Pennsylvania couldn't care less, right? As long as you don't have 15 of these funds, right? There's no regulatory issue. Other states are like, we don't have a problem. Like Texas, we don't have a problem, but you could only raise money from accredited investors, for example, right? That's a limitation in Texas. Okay. And then you go all the way to the other side, like Massachusetts or even the state of Washington, where not only do they have to be accredited, but they actually have to have $2 million in net worth, not $1 million in net worth, which usually blows that whole thing. And so again, you don't need to memorize this stuff. You don't need to know this, but you just need to be aware you have to just be able to identify that if you're going to be doing the fund of funds, you want to make sure you're talking to your securities attorney to make sure you're not violating the investment advisory rules. There's also concerns about the Investment Companies Act because you're a holding company, and there's a whole bunch of stuff. So just make sure you're talking to your securities attorney before you start doing anything crazy.
Okay, fantastic. No, I appreciate that. You made a reference to Washington where it's, instead of a $1 million net worth, it's $2 million. So I know there was some chatter related to the definition as relates to an accredited investor. Has that actually changed yet, or is it coming down the pike?
Yeah. So it's really weird. And I've actually done some content on this. It's actually, it's actually expanded. The definition of who can be an accredited has expanded. The plan was to expand it a lot. Right now, it's only expanded a little bit with the promise of expanding it a lot literally any day now. But then, so I'll talk about it in a second, but then at the same time, they're now talking about restricting. So it's like they're expanding, but they're also restricting. So let's go through that, because I know it sounds a little bit counterintuitive, but actually for me, it makes a ton of sense. And so maybe I'm wrong, but I'll share with you my thoughts. So the rule now is, as of, I want to say this was December, not of last year, but the year before, whatever year that was, they expanded the definition and said, look, we all know that people that net worth and income, which is the current definition, we all know people who have a lot of money who are complete idiots, and we all know people who don't have a lot of money that are smartest people in the room. So maybe, and this debate's been going on for many years, maybe that's not the best way to do it. So why don't we create a certification program where somebody can actually become certified to become an accredited investor? Meaning you go take an exam from an accredited school, and whether that's a class or a seminar or a self-study, we don't know, but we'll go take an exam. I pass the test, and boom, now I'm an accredited investor irrespective of my income. So that sounded amazing, because that's great, because now you can go take it. And again, we didn't know whether that was self-study or a 6-month semester or a year, like whatever. But they said as of today, or as of December of a year and a half ago, any investment advisors will automatically be accredited now. So if you've got a Series 7, a Series 65, or Series 82, and you're qualified in your particular state, then even if you don't have the net worth requirement, you are going to be an accredited investor. Great. And then again, almost 2 years ago now, we were then waiting for the SEC to come out with his other license certificate. That hasn't happened, right? We're still waiting on the other expansion. And then there was rumors, and there was some talk from the SEC about them wanting to increase the accredited investor number from the $1 million today to $10 million. And everybody was up in arms because, that would crush a lot of, you would lose a lot of accredited investors if instead of being $1 million net worth, it was 10. It turned out that it wasn't the way it was framed. It really wasn't 10 million. It was actually, it was if they were investing in a deal that had over $10 million, so it's a little bit different. But there are rumors, strong rumors, that they are considering raising that threshold from $1 million to something, right? And my thought there is, look, the accredited investor definition was passed in 1982, right? Where $1 million back then was a lot of money. And if you just adjust for inflation, or at least the official rate of inflation, you're almost at 3 million, right? So it would make us a ton of sense just from just an inflation standpoint to update that number from 1 million to 3 million, right? Maybe it's 5, maybe it's 10, maybe it's 0. That I wouldn't be surprised if they raise it to 3 million. And it does make sense with this other law that's already passed, because if you are going to allow anybody essentially to go take an exam and go get certified to become an accredited investor, then it's not crazy to assume that the automatic qualification, which is the net worth, would be increased. And so the automatic piece would be a little bit harder, maybe again, like 3 million. So if you're currently an accredited investor between 1 and 3, yes, you're not automatically an accredited investor, but you can go take the exam now and get accredited that way. So
I like that.
I don't think they're counter. Yeah, they make sense to me.
Yeah. So you think you truly think it's going to be either or? That's probably what they'll land on.
No, I think it's both. I think that when they patent, I've read some of the
right. That's actually right, man. Either you go take the test, you don't have a $3 million net worth. You go take the test, you can pass the test, even though you have a $10,000 net worth, but you can go invest in the deal if you would like. Or
right. And again, maybe they raise it. Maybe they do raise it to 10. Maybe they raise it to 2. Maybe they don't raise it at all. They were supposed to have it on. It's on the regulatory agenda for this spring, which means basically between now and the end of the year. There were, again, rumors that they were going to address it back in April. And so basically since May, I've been checking the website and the press releases almost weekly. I wouldn't say daily, but at least once a week, I pop in there just to make sure I don't miss anything. And as soon as something comes out, because what's going to happen, Kevin, is there's going to be a proposed rule, right? They're going to come out with a rule and they're going to say, here's what we think you should do. Then there's a whole comment period. There's 30 days for me, you, anybody who's, part of the community to go to make comments and suggestions, say, this is crazy, this is a great idea, how about this, how about that? So they take that all into consideration, and typically will release a final rule after taking all that into consideration. But that was supposed to happen in April, let's call it April, May. Here we are, September.
Is there not an argument around, do I really need the government and Securities and Exchange Commission to protect me?
100%.
Seriously, I mean, come on, they haven't really proven themselves over the last couple of 100 years, and so it's just generally speaking, the government in general. But I mean, it's
100%.
do you guys really? Is it really our best interest that you have in mind? I mean, anyway, just
well, no,
that's
and,
always.
You get the conspiracy. I don't think conspiracy theories. My good friend Russell Gray, he actually wrote when the 506C rule came out in 2013. He wrote a huge thing about breaking Wall Street's monopoly, but he always feared and always said that the lobbyists, because it's taken a lot of money away from Wall Street. This idea of now that we can kind of do the 506Cs and basically advertise, even though technically it's a private offering, and so a lot of money has stopped going to Wall Street, and less people are going public, because why go public when I can just raise as much I can raise under 506E. BlackRock is raising, I think now it's $50 billion fund. Like, why do they don't need to go public? The only time you're forced to go public is if you end up having more than 2,000 investors or more than 500 non-accredited investors. And so, but as long as, if you're a Facebook or you're one of these startups, at some point, you may have to go public. But generally speaking, if BlackRock can go raise 50 billion privately. So anyway, I think that's a lobbying has gone in there from Wall Street firms to try and make it harder for people to raise money on the private side. So people are forced to go to the public markets where they make their money. Makes sense.
So I'm gonna flip the script a little bit, and given the line of work that you're in, you've got a lot of clients just like us, right, that are active real estate investors. And what I'd love to hear from you is just any chatter that you've heard over the last 6 or 8 months, and just even those that are talking about kind of what the future entails and what they're planning for as it relates to, market softening, interest rate volatility, just how they're navigating these somewhat, muddy waters.
Yeah, I mean, we've definitely felt a change. We first felt the change right after COVID. Again, not for some reason, everything died in COVID. Like, we didn't do a single deal for like 2 months once the banks were lending or whatever. And then at the end of that year in COVID, it's been a rocket ship upwards for us. And, we've probably quadrupled in size, if not more, since then. But what I've noticed, just like you mentioned something just at the beginning when you said over the last couple of months, it's kind of your deal flow had slowed, or at least before that, your deal flow had slowed down. Things had slowed. I am seeing that. I've kind of cut my pulse on that. We do, hundreds of these every year. We usually do about 15, 20, 25 of these every month. And over the last 2.5 months or so, it's slowed down. It's slowed down quite a bit. And the feedback that I get from the clients is, look, we're still looking, it's still all this, but we're being a little bit more careful. It's got to be a really screaming deal. It's going to be really great, because they have this feeling that it's a little bit harder to go raise capital right now, especially with, I think, one of the main reasons, at least in the short term, has been the stock market really not collapsing, but going down significantly, that a passive investor doesn't necessarily want to liquidate their stock to go put it in real estate, because they don't want to capture that loss.
Yeah.
And just even I've got my show as well, and I always ask syndicators who come on there, it's like, kind of give me the war stories, and they're just getting a lot of feedback from even people who are like, they're crushing it, right? They're getting great returns, but hey, we're going to sit this one out. We're not going to roll over the next deal you have. We're going to sit this one out. So it's definitely getting harder and harder to raise the capital, which means is either, you could look at that as a good thing or a bad thing. If you're an established syndicator like yourself, or a lot of our clients, then it kind of weeds out the smaller folks, because it's harder. But if you've got a solid relationship with a base of all investors, and you've got a relationship with them, you can still make it happen. And as opposed to somebody who's just started off and they've just done 1 or 2 deals and don't really have a reputation, it might be harder for them to go get across the finish line. But it is getting harder out there. Whether it's transitory
You're right.
Not. We had a big pickup.
Love that definition.
We've had a big pickup here in the last what you said today is very similar to what I'm seeing. Yeah. We've had a large pickup in the last 2 to 3 weeks, I would say, versus the last quarter. And we'll see what this next month and the end of the year will hold.
As it relates to the retail investors out there, maybe the trepidation that they might be having with maybe they've had some losses in the market, what have you. But do you Can you all do you believe that some of that can be chalked up to, just all the headlines are doom and gloom and I don't want this to sound derogatory. It's not meant to be, but to where the average retail investor might not be able to make their own interpretation as to what's really happening. All they're really seeing is the headlines, and it overwhelms. I mean, if you literally watch the news, whether you're on, CNN or Fox, whichever side you choose, or whatever publication you read, it's hard not to get overwhelmed with the negativity. And so would you say that
no, I
a
think
good bit of that trepidation is a direct result of the main headlines and media?
100%. In fact, we had a discussion not too long about, are we going into recession? Are we in a recession? We had that whole recession discussion. And one of the biggest factors of whether, we are either heading into a recession or how quickly is consumer sentiment. Right. Forget about the reality, but just the sentiment. And so to your point, if people are reading, in the news and the headlines and all that stuff about doom and gloom and all that stuff, it almost becomes a self-fulfilling prophecy, because even though we're in good shape, I'm not saying we are, but even if we were in good shape, if people feel like we're not in good shape, their actions are going to follow that belief, and they're going to hold back, and that's going to basically perpetuate the self-fulfilling prophecy that came at the head. So I 100% agree with that. Yeah, I mean, we'll see what happens here. I think, in the next couple of months to see what the headlines, what it looks like.
So how about your investing activity on a personal level? What asset type is your preference? Markets that you absolutely love? I mean, just where are you hedging your bets at present time?
Yeah, well, on the hedging side, I don't do any direct investing. I do it all through syndication. Actually, I'm a limited partner in several deals.
Mm-hmm.
But the way I have been hedging a lot, actually, the last probably almost 2 years now, is it's a really kind of off topic here, but I do a lot of oil and gas stuff. And the reason for the oil and gas stuff is primarily for the tax benefits. The working interest in oil wells is just a huge, I can actually write off active income for me. And as we see, as a professional, high earning professional, that's a big thing for me. And so that's been a very successful thing for me. But I love real estate. I love your market, actually. I love that whole sort of Tampa, Orlando corridor is probably one of my favorite markets that I always have an eye on. And at some point I'll probably dabble. It'll be fun to go do a small, 15 unit deal or something. And that's probably where I'll end up going, because that whole corridor has been on my radar now for 2 or 3 years. And so that's kind of my favorite market. But my asset class right now, to be honest with you, is actually in the oil and gas. But again, it's mostly the tax tail wagging the dog.
Yeah, maybe we'll have to have a separate conversation or a separate show on oil and gas investments.
Would love to. Yeah, would love to.
I am not familiar at all with that world. So, moving on here, and just going to end this out with more of a generalized question for you, Mauricio, and it's for those again that are maybe they're looking to go down this path and formulate their own syndication, whether they're going to act as a GP and be the primary sponsor, whether they're going to put together a fund to fund. It doesn't really make a difference. But as far as what separates a great securities attorney from a mediocre one, right? I mean, I'm sure that if you just go, and I did not do this, but I'm guessing that if you go in and Google Reg D 506C or securities attorney, I mean, I'm sure that there's pages upon pages, many with paid ads on top, where people are paying to promote, their firm or their service. And so, how do we piece through all the noise and find the right fit?
Yeah, I mean, I think, obviously some of these answers will be a little bit self-serving, so I want to be upfront about that. But look, I truly believe that syndication is a very specialized niche. If that's even the right way to say it. That may be redundant. But so you really want to have a securities attorney, and there's a few of us out there, not a lot, but there's a few of us, and we're all friendly competitors, and we all get along. But that really does real estate syndications full time.
Mm-hmm.
There are plenty of firms that dabble in syndication, that 25% of the practice is syndication, and they do a bunch of different things. We do exclusively syndication. This is what we do day in and day out. And as I mentioned earlier in the show, and the reason that's important is that because we do it day in and day out, and it's really specifically on the real estate side, not even, we don't really do startups or anything, any crazy stuff. It's real estate, that we have that bag of tricks. And I think that's one of my biggest pet peeves, so to speak, or just sometimes frustrations, is that, I do try and make everything simple. My content tries to speak, in plain English. Tom Wheelwright likes to say I'm one of the few lawyers that actually speaks English, which is a nice compliment. So I try and simplify things, but securities laws is extremely complex. And I like to say, as I mentioned the analogy, there's a bag of tricks or knowledge that's in the back of our head that most of the time, 99% of the time, we don't dig into. But if you don't do it day in and day out, you're not going to be able to spot, oh, wait a minute. Oh, it's a fund of funds. You need to be an investment advisor. We need to go down that route. Like if you've never done this or you don't do this full time, you may not pick that up. Or on the social media advertising, you may not realize that you're conditioning the market, or that even if you're doing a 506c, you can't just post whatever you want. It's one of my things that is going on in the last couple of weeks, like seeing even my own clients, to be fair, people posting stuff on social media that I'm like, even though it's a 506c, you don't get carte blanche, say whatever you want. So having that bag of tricks can only be done by somebody who does it day in and day out. And I would say there's probably, I'm sure there's more, but in my world, there's probably, I would say 6 or 7 of us that are out there that really just do this. And those are probably the same folks your audience is familiar with, go to the seminars that you attend. There's only like 6 or 7 of us. Everybody else, there are larger law firms, but they do 100 different things or 5 different things, and they don't just specialize full time on real estate syndication. So to me, that's the most important one.
Yeah, no, that's great advice. I had someone reach out to me months ago, and I don't remember the name of the service, but they referenced kind of a done for you service. I mean, it's like a web-based service that put together the PPM, and I'm sure it was just boilerplate, boilerplate PPM, boilerplate operating agreement, and what have you. And I said, it's kind of like online chat to get this done, right? Like you're not actually dealing with over the phone, or having a consultation with the securities attorney, at least not a live one. I was like, I think I'd go a different direction, my friend.
And that's one of my biggest pet peeves is people think it's just about banging out a bunch of docs. And while that's obviously important, that's your deliverable. I always argue that's maybe 20-25% of what we do is actually the document. So you want to have a full service people. We're not the cheapest firm by any means, but we have sort of that white glove. We're kind of known for that white glove service. We're customer obsessed. We want to make sure that you have unlimited time with us and all of those things, that it's not just here's the questionnaire, fill it out, and then we'll bang out a bunch of docs for you, because then all of that compliance, nobody's checking. Like, how else is somebody going to know whether there's something else going on unless you're having conversations with them and your attorney's asking you questions? So just make sure that you've got a lot of time with the attorney, that they're peppering you with questions so they can pull out all those risks and put them in the docs, because the docs are kind of worthless without the proper information.
Save money on finding the right opportunities and the right deals. Don't save money on putting together your offering.
Right.
And skip it on your securities attorney. So Mauricio, it's been a lot of fun having you, my friend. I really appreciate you coming on. For those that want to learn more about you and your services, and you've got an awesome YouTube channel. I mean, you put out a lot of great content. So please let our listeners know how they can learn more and find out more and watch what you got going on.
Yeah, I've got a YouTube channel, so a lot of my content is there on YouTube. So I'd love for people to go check it out. If you like the content, I'd love to subscribe. LinkedIn, I'm very active on LinkedIn. And then I've got a Facebook group, which is the Real Estate Syndicator Community. You can just find me on the Facebook group. Definitely let me know that you are listening to this episode, so I'd let you in there. But that's just a really neat community where I spend most of my time. I'm just hanging out in the community, asking questions to everybody. And it's not just law, right? It's everything. It's underwriting, it's taxes, it's, K principles, it's finding market. So really encourage you guys to go to the Real Estate Syndicator Community Facebook page.
All righty. Fantastic. Guys, I'll put all that in the show notes. Mauricio, it's been a pleasure, my friend. Hopefully I'll see your face at an upcoming event. I'm sure I will. And so until then, my friend, you take care and be great. Okay.
Thanks, my friend. Good having you. Thanks for having me on the show.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.